Hi guys, it's Stock Harry, and bank stocks sold off today after the Credit Suisse collapse spread fears of bank failures around the world. Despite this, it is not 2008 all over again. I'm going to explain why, so let's get into it. Stock markets tumbled around the world as bank fears go global. Stocks fell sharply this morning, with banking stocks taking a beating as Tuesday's rally quickly faded. This all started after Credit Suisse shares tanked after the Saudi backer ruled out further assistance. The fear here is that the Saudis had done their due diligence and they found that Credit Suisse was unable to be saved as a bank. They were unwilling to put any more money into them, and this spread major fears that Credit Suisse would be the next bank to collapse. Credit Suisse shares plunged as the bank storm spread to Europe. This intensification of the Swiss lender's difficulties comes just days after two major bank failures in the United States. So who is Credit Suisse and why do they matter to U.S. banks? Well, Credit Suisse is a Swiss bank that was founded in 1856. It's over 150 years old. They have 50,000 employees throughout the world. Credit Suisse is a major bank, and if Credit Suisse were to go out of business, it would be the largest bank failure in world history. Unfortunately, Credit Suisse, because they're not an American company, they do not have the same protections that American banks have. Luckily, the Swiss government was starting to hold talks on options to stabilize Credit Suisse, and this caused bank stocks to rally once this information came out. Later, near the market close, it was announced that Swiss regulators would provide liquidity to Credit Suisse. So Credit Suisse is not an American bank. They have nothing to do with American banks, but they did cause a lot of fear that the bank failures that occurred in the United States over the weekend would spread throughout the world in a major 2008 worldwide financial collapse. But this isn't necessarily the case, and I'm going to explain why. First of all, U.S. banks are now safe. U.S. banks essentially have an unlimited loan available to them from the Federal Reserve. So if any more U.S. banks get into trouble, not only can they sell their assets at par value instead of the major losses that caused a lot of these bank failures in the first place, on top of that, they also have access to an unlimited amount of capital to keep them afloat. So American banks literally cannot collapse because they have an unlimited amount of money available to them. So American banks are no longer in trouble. And once the fears sort of subside and this is realized, American bank stocks are going to rebound in a major way. Now, trying to time when they rebound is extremely difficult, but they will rebound. It may take a week or 2 or 3 weeks. Eventually, they're going back up. The problem with Credit Suisse is that this is not something where the American bank failures have now spread worldwide and have now caused fears of this worldwide collapse. I mean, yes, the fears are there, but they're not grounded in reality. The fact of the matter is, Credit Suisse has been having troubles for years. This is nothing new. If anything, the problems with Credit Suisse spread to America, not the other way around. And the problems with Credit Suisse aren't so much that they have losses on their investments. It's really more of a mismanagement issue when it comes to Credit Suisse. Luckily, now the Swiss government has come in and they said, we are essentially going to bail out Credit Suisse. They're going to provide them with additional liquidity to keep them afloat, knowing full well that if Credit Suisse were to go out of business, it would cause those major ramifications throughout the world and could collapse the entire world stock market and banking system, at least temporarily. And the Swiss government and the American government recognize this. They are actually working together to help shore up Credit Suisse. So the fears should mostly be gone, although we are going to need a couple of weeks of essentially no news and no more issues with banks before the fears really start to subside and bank stocks can start rising once again. This may take up to 3 weeks for those fears to subside. A lot of people have 2008 fresh in their minds, and every single time you hear of a problem with a bank, people immediately think 2008 financial crisis. But in reality, it's not, because in 2008, it took weeks or months for the federal government to step in and bail out the banks. And this time around, it literally took hours for the federal government to step in and bail out banks. So we're in a very different situation than we were in 2008. If you want to think about it in the terms of 2008, we're kind of at the very end of 2008 when the federal government essentially jumped in with unlimited money, unlimited quantitative easing, and just threw a ton of money at the markets to shore up the banks and the markets. That's the point that we're in. The end of 2008, once all the problems were essentially being solved by the government. Of course, it still took time for stocks to rise and rebound, but they will get there because with unlimited money printing, there can't be any more problems. Now, I do want to go back to Credit Suisse and kind of explain a little bit more about what's going on with them because, like I said, their problems go back years. This is nothing new. The news across the board reported that investor confidence in Credit Suisse crumbled Wednesday, unleashing worries that a banking crisis centered amongst U.S. regional banks had spread across the Atlantic and was poised to unleash substantial damage to the markets and the economy. Of course, it's not true. As I said, the problems with Credit Suisse go back years, completely unrelated issues. Now, before the regulator announcement, shares in the Swiss Bank had slid 24% to a new low. And once it came out that the Swiss government was going to essentially bail out Credit Suisse, Credit Suisse's American Depository Receipts, or ADRs, those are the shares that trade in the United States, they jumped in the minutes after the announcement. Now, the fear that many investors had was that if regulators do not handle the Credit Suisse situation well, it would send shockwaves throughout the entire banking sector worldwide. But the fact is, Credit Suisse has been the problem child for European banking for several years. There have been repeated scandals and financial losses that have hammered the 166-year-old bank over the past few years. Now, even though Credit Suisse has cycled through numerous executives and made repeated attempts to stabilize its reputation, the bank is still faced an exodus of client withdrawals, which has started to cause the problems that we've seen over the past 2 years. Over the past 2 years, the bank's difficulties have accumulated in a drumbeat fashion with little respite for worried Credit Suisse investors. Then on Tuesday, the bank said it found material weakness in its financial reporting. Basically, there was some fraud going on and it just wasn't reported correctly. Now, while the errors didn't change the company's financials, the failure did reinforce worries about the bank's ability to stay out of trouble. Now, even though Credit Suisse's banking troubles are unique and limited to Credit Suisse due to the massive amount of fraud, the fact is investors are wondering when one part of the financial system goes into crisis, it's normal for there to be some contagion to the whole system, and investors tend to wonder, who's next? Now, despite the problems with Credit Suisse being unique and localized, financial shares in the United States fell as Credit Suisse became the latest crisis for the banking sector. While Credit Suisse's woes are unrelated to mid-tier U.S. banks, the combination of the two issues has sparked a broader re-examination of the banking system among investors. The fact is, few investors had bank failures on their list of potential market risks, but now the bank chaos is clouding the outlook for the future of the US stock market. One of the biggest worries that we have here in the United States that is actually a real problem is the fact that some of the regional banks might get downgraded. Now, I talked about this yesterday, how one of the bullets the market was going to have to dodge today was that regional banks do not get downgraded. And if they did, this could cause those stocks to fall pretty significantly. Well, unfortunately, the banks did get downgraded, and First Republic Bank got hit with a 4-notch credit downgrade. S&P Global downgraded the bank's rating by 4 notches to BB plus on Wednesday. That change gives the bank speculative grade or junk bond status. This is going to make it very expensive for First Republic Bank to borrow money in order to keep themselves alive. And as a result, their shares were down over 20% on Wednesday. And unfortunately, this banking fallout is having ramifications in the housing sector as well. Home builders say demand is rising, but they're concerned about the banking fallout. While new construction starts have slowed dramatically over the past few months, home builders are starting to feel a little bit better about the market for starting to build some new single-family homes. This is actually the third straight monthly increase in builder sentiment in a row. An increase in homebuilder sentiment means that homebuilders might start creating some new homes here very soon or in the future. And if that does, that could cause a boost to the housing market, which could really help the economy. Homebuilder sentiment had hit some multi-year lows just a few months ago. Now it's starting to rebound. Now, the news that everybody had their eye out on Wednesday was the PPI, or Producer Price Index. We were very afraid that with the extremely low expectations for PPI, that PPI might come in higher than expected, causing major problems for the Federal Reserve in trying to determine how much to raise interest rates by. But once we got the actual numbers, it was a huge sigh of relief. While the Producer Price Index was expected to be flat month over month as a 0.3% month over month increase, it actually came in at a negative 0.1 month over month decrease. So the inflation on the PPI actually went down, and we have not seen actual decrease in inflation on a single report yet. So that was huge news. The core PPI also came in lower than expected. It was expected to drop to 0.4% from 0.5% last month, and it actually came in at only a 0.2% month over month increase. Now, on an annualized basis, that puts PPI at a 4.6% and core PPI at 4.4%. This is still more than double where the Federal Reserve would like to see inflation at. Their goal is 2%. Regardless, this is a significant decrease in inflation and excellent news for the markets. This means that the Federal Reserve can now do a significantly lower rate hike, or possibly even pause the rate hikes, since inflation is actually starting to show signs of cooling down. It means that the January ultra-high inflation numbers were perhaps just a one-off, as February has now continued the decrease in inflation that we've seen over the past few months. And while wholesale prices posted an unexpected decline of 0.1% in February, retail sales also fell. Retail sales fell 0.4% in February, which was in line with expectations. Retail sales are another indication of consumer spending. And remember, the Federal Reserve needs to get consumer spending down in order to get inflation down. That is now happening. So it was all really great news on the inflation front on Wednesday. Now, even though a slowdown in inflation is good news, unfortunately, the economy is showing signs of cooling down as the bank troubles spread and retail spending falls. Apple supplier Foxconn expects a decline in consumer electronics demand. And Diamond Sports, the largest owner of regional sports networks, just filed for bankruptcy, while Virgin Orbit paused operations for a week as they furloughed nearly the entire staff as they try to seek funding. And oil fell to the lowest level since December of 2021 as the banking crisis has roused the markets. Oil has dropped as there is a fear of a global economic slowdown. The fact is, a recession could come sooner than most people think as bank lending slows down. Remember, the key way that the Federal Reserve will cause inflation to come down is by tightening financial conditions, meaning it gets harder and harder to get a loan. And as banks struggle with these loans that they're already losing money on, they are going to have to cut back on their lending, which means they're going to have increased lending standards, making it harder to get a loan. And this actually has the effect of slowing down the economy really fast because ultimately this economy in the United States grows when there's easy access to money and very low interest rates. Now that we have high interest rates, well, really just more normal interest rates, as well as tighter lending standards from the banks, this really helps slow down the economy. It's everything the Federal Reserve was trying to accomplish, and now it appears like it's all happening all at once. Unfortunately, it's important to understand that when the Fed raises interest rates, it takes about 6 months for that rise in interest rates to spread throughout the economy. And we still have 5 months of rate increases that have not yet hit the economy, yet the economy is already showing signs of going into a recession, meaning it's possible that the Federal Reserve already raised interest rates too much and has already triggered a recession that will show up in the official numbers any month now. And things are about to get worse for millions of consumers as student loan bills are set to come due in a few months, which is going to add a lot of pressure on younger Americans. All of these fears of an economic slowdown and a recession in the United States has caused trading in U.S. Treasuries to come to a near standstill. Traders say making deals and selling treasuries is as hard as it was in the early days of COVID-19. U.S. Treasuries have fallen at the fastest rate since the Black Monday market crash of 1987. This is an historic drop in Treasury yields, as well as an historic rise in Treasury prices as trillions of dollars gets pumped into Treasuries as investors seek safe havens before what they believe is going to be the Federal Reserve starting to cut interest rates by the end of this year. Before the bank collapses started last week, the market was pricing in an 80% chance of the Federal Reserve doing a 50 basis point rate hike. Now, the markets are pricing in a 0% chance of a 50 basis point rate hike, and even only a 48% chance of a 25 basis point rate hike. The market's actually pricing in a 52% chance or a majority chance that the Fed is actually going to pause at their meeting next week. With all of the major economic data now out of the way, all eyes are going to be on the Fed meeting next week, and everybody is wondering what the Fed is going to do. The market is either going to rally or crash on Wednesday next week when the Federal Reserve releases their decision on how much they're going to raise interest rates by, as well as, more importantly, possibly, what they are going to do with their quantitative tightening that they've been doing. Are they going to pause that? We don't know, but we're going to find out in 1 week. Let me know in the comments below what you think the Federal Reserve is going to do next week. Are they going to raise rates, pause, or maybe even cut rates like Nomura thinks they will? Let me know what you think the Fed is going to do in the comments below. And if you want to chat with me throughout the day, I am active in our We Profit Day and Night coaching program all day long throughout the trading day. I talk about what trades I'm making, and we help you with your trades, help you make better trading decisions so that you can become more profitable. We have people in there who have never traded options before. They're learning how to trade options, and they're making a ton of money. If you want to learn how to make money no matter whether the market goes up, down, or even trade sideways, come join us in our We Profit Day and Night coaching program. You're also going to get access to free premium market alerts. These alerts give you huge insights into what the large institutions and whales are doing in trading. These alerts would normally cost you $699 a year. That's $700 a year in alerts you're going to get free of charge when you join the We Profit Day and Night coaching program. And right now, I'm offering a 20% discount to all former VIP Discord members that now want to rejoin. This is an incredible opportunity to get a huge discount on the We Profit Day and Night coaching program if you're interested in coming back and rejoining us once again. Whether you're brand new or you were previously a VIP member and you're now ready to come back, schedule a call with my onboarding specialist at weprofitdayandnight.com to get into the Discord and join me throughout the trading day so that you can make money with us. Again, that's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family and on your social media pages so that other people will know what's going on with this banking crisis as well, and we can eliminate some of these 2008 fears together. And don't forget to hit the like button and subscribe. And if you missed my video yesterday where I went into a little bit more details about PPI and some of the other bullets that the market is going to have to dodge if it wants to go back up, make sure you watch the last video that I uploaded here.